Hi everyone, welcome back to Be Rich. I hope you've been enjoying the treat I managed to pull up. Anand and Shasha doing a couple of videos on the channel for you guys. Yes, I'm still in Bangalore. I should be back in the studio next week. So when I'm back in the studio, the video quality will improve, the audio quality will improve. I'm sorry that I'm doing this remotely, but I don't have a choice. And I would like to get a video out to you and would like to keep that consistency going. So that is the effort behind this. So what did I want to talk about today today, of course, the markets are closed. It's the weekend. It's a Saturday. I hope you're having a wonderful Saturday. And this Saturday evening is fruitful, as they say. I had put up a recent article in Medium about market and when will the market crash? When is it expected to crash? And what will cause this market correction to happen? I hope you did read that article. And I thought I'd discuss that article today and outline what and if and when is it possible for this market, this bull run to come to an end? Yes, we did have a small hiccup during the polls. When the exit polls came out and the actual numbers came out, we did see a surge, and that surge collapsed immediately the next day once it became apparent things were not as promised. And we did discuss that. And since then, the market has been going on a run like a runaway freight train, and it's hurtling along. And there's a lot of questions being asked. This is kind of evaluations, eye-watering evaluations make sense. And the reason why we are asking this is because though there's confidence in the market, there's no doubt about it, numbers are there in the market, we have reached unprecedented levels of evaluations in the market right now. And it's going to take equally something monumental is what the feeling is to see a correction of sorts. But sometimes corrections can blindside us and, we'd like to think that we are living in a world which is maybe complicated, and we can understand it. And, we can apply some kind of formula to it. Because most complicated systems can be understood like a watch. Though a watch is a complex, especially I'm talking about a wristwatch, even electronic watches, this is true. If you talk about a clock like a wristwatch, though the gears in there are moving are very complicated and can seem hard to understand, but by applying ourselves and spending time behind it, we can understand how the gears work. And if something breaks down, a spring, we can fix it, we can look at it, and we can figure it out. This applies to anything which is complicated. We can look at it, apply some science or maths and figure it out. But unfortunately, the markets are not complicated, but they're complex. The thing in a complex system is every single thing, be it a small or a large action, has consequences, and it's very hard to see how the interdependency of this whole system is. This is akin to any system we see in nature. That is why it's very hard to understand what happens in nature. Very famously, a good analogy would be when Mao came to power in China, there was a lot of suffering due to disease in rural China and in cities in China. So he came out with a four prey policy where he told the people to get rid of birds, swallows, that is, rats, insects, and people went around eradicating these so-called pests. And what happened was when the swallows were all removed and they were killed off, there was no check for the locusts which were there in the environment, because the natural predator for locusts were swallows. And when the locust population went unchecked, it led to swarms of locusts. And you know what happens with swarms of locusts? They went around devouring all the crops, which led to 55 million deaths in China due to famine. And he could not see this because the system is very complex. This is very true with our stock market. Our stock market is a very complex system, and we do not know what could be the grain or the salt which will break the camel's back. And it does look like that. It does look like when you see the monumental speed the market is going at and the levels we are at, to shatter the belief in this kind of market, because everyone participating in the market seems to be of strong belief that no, we deserve these kind of evaluations. We should be not worried, and this is going to go on and on and on, and nothing goes on forever. Prices don't go on increasing forever. There are times when things turn around. And a big bubble like this will require a big pin to burst, is what the feeling is. And I don't think that necessarily is true. And the reason is challenges can come from anywhere, be it a macroeconomic challenge. Macroeconomic challenge is something that's political, social instability can rattle the market, rattle investors, and they can pull out. Second, could be a government policy which does this. Right now, our government is not the same government which was there last time around. Our government right now is a coalition government, and it requires partners and partners to believe in what they're doing, to work with the government, to enable policies to push through. And this may even lead to policies that don't make sense. Taxation may not make sense. So this may cause some kind of rattle in the market. Can't say. Can happen. And higher regulation might cause, market to swing the other way, especially our public sector stocks. The valuations of some of our public stocks are crazy at where they are, considering the fact that the government is running these. If you ask any normal citizen his belief how government runs things, he'll laugh at you and say, "Your government can't run things for nuts." But the same citizen is the same one who's buying these government stocks at eye-watering evaluations saying, no, yes, the government owns these companies, government companies are safe. But governments don't run businesses very well. So that's where it is kind of strange to see this behavior. Then corporate earnings may not come. Lots of us believe that these earnings will go on and on, increasing indefinitely. It may not be the case. Corporate earnings may slump. And I do feel if we see corporate earnings slump for 3-4 consecutive quarters, things may change. Investor sentiments may change because one single quarter earning going negative, the amount of high spirits we have in the market right now may not dampen investors. So it may take a couple of quarters of bad earnings. Inflation still hasn't left us. And globally speaking, inflation is everywhere. And even the Fed, for the simple reason they're not aggressively cutting interest rates, is because of that. Inflation is still something they're keeping an eye on. And that is the main mandate for the Fed. We may, as analysts and investors, sit around the armchair and talk about this and that about Fed ruling, but Fed's main reason for raising the interest rates was to control and curtail inflation. And the strong dollar is not going to help America for the simple reason is imports into US become cheaper and cheaper. As imports become cheaper and cheaper, more products pouring into the US, no matter how much tariff they increase and to put, because businessmen and businesswomen would find ways legally to work through these so-called tariffs to get their products in at a lower cost so they can make better profits. You know what I mean. This fuels further inflation. Very hard to control this. Rising protectionism, which we are seeing. You see it all over Europe now. So-called the liberals are fearing that the rights are coming back into power and they're going to get very protectionist, and this can lead to investor sentiments being swayed. Like what we are seeing right now in the Swiss court, news broke about jail term being awarded to the Hindujas. I'm not going to get into that case, but I'm saying, there is a sense if investors feel a little shaky on what is happening in the country, like in India, about our laws, about being protectionism, maybe they'll feel their money's investments are not safe and pull out. Like I did another podcast with Arun where I had spoken about FDI's reports coming out. They're at an all-time low. We're at levels of 2007. That is a long time ago. And if foreign direct investments are being pulled out of India, that shows you that sentiments and protectionism is very much there on the cards of investors' minds. Because the reason why FDIs are pulling currency out will only be because if they feel they're not safe, their investment bets are not safe in the country, they won't have access to their investments in terms of controlling it, influencing companies and influencing boards into things that make sense for them. This is why you even see companies like Hyundai thinking of doing IPOs here because they can take off whatever they've built, goodwill they've built in India, put an IPO and take some money out because Indian markets are at eye-watering evaluations. Even Coca-Cola is considering this. So this coupled with, where Fed stands, if Fed continues holding on these interest rates, it might happen. And there is weaknesses even in large cap, though we're not able to see it because we are all very keen on holding this bull position. If you really peel back and look at some of the large caps, where they are, how they are sitting, it can show a lot of weaknesses there. Even the way Nvidia stock has gone through the roof. Is it a bubble? Is it artificial intelligence a bubble or not? We got parties on both sides because it is going to a cliff's edge. And all it's going to take is a couple of reports of weak earnings or falling sales numbers, and this whole thing can come unraveling quite fast. It may not require a big pin to burst this big bubble we are sitting on. It might be just something small and inconsequential is what I'm trying to say. And this is where the problem lies, because these kinds of things we cannot forecast, we cannot see them, we cannot build models to see it, nor can we have an equation which we can plug in and say, yes, the market is going to correct at this time. So what do we do as investors at this point of time? Well, as investors, what we do is we follow Peter Lynch, as he said. We look for companies which are businesses which we understand, which we believe in, and we look at investing in these companies and businesses because we believe in them and we understand them. And we invest in small increments over the periods of time. So to build our trust and fortify ourselves in terms of costing, and we hold on to it for the long term and make sure we build understanding in this business, that any impact that comes in the business, we're able to see and analyze it and move our investments according to that. That is the only way to work through these kinds of markets we're seeing right now. And should you be timing the market? I'm not a strong believer that you can ever time the market. Yes, it's very easy to see in hindsight that you should have jumped in when the market crashed on that day. But there have been times, the days of corrections could have come and you could have maybe missed and jumped in too early and, be licking your wounds now. So I do not believe in these market timings. Looking back, you can always see it very clearly. But looking forward, it's as foggy as ever. So my advice would be to keep investing, add value. If you see value, keep buying and keep holding for the long term. And these overvaluation markets, yes, it is scary. If you should be booking profit or not is something that you will have to take a long, hard call on and see. If you're gone up, let's say a good 300%, your capital is gained. Maybe you can pull out your capital out of those investments and just leave the profit on the table. Something to consider. Anyway, I hope you found this video informative and entertaining and gave you kind of some food for thought about where we are sitting and what can lead to a change in our market scenario. And I'll see you in the next one soon. Thank you for watching the video today. Bye.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.